In today's rapidly changing financial world, one principle has become more important than ever for investors of all levels: diversification. Whether you are a beginner just starting your investment journey or an experienced investor managing a large portfolio, the idea of not putting all your eggs in one basket is no longer just a cautionary saying. It is a survival strategy. Markets today are influenced by countless unpredictable factors, including global economic shifts, geopolitical tensions, technological disruption, interest rate changes, and sudden market sentiment swings driven by news and social media. In such an environment, relying on a single stock, sector, or asset class can expose you to unnecessary and sometimes devastating risk. Diversification is not about maximizing returns overnight. It is about protecting your capital while still allowing your wealth to grow steadily over time. To understand why diversification matters so much right now, we first need to recognize how unpredictable modern markets have become. In the past, investors could often rely on long-term trends in specific industries or national economies. But today, even strong companies can experience sudden drops due to external forces beyond their control. A tech company might report strong earnings, yet its stock price could fall because of rising interest rates. A stable energy company might struggle due to sudden regulatory changes or global supply chain disruptions. Even entire markets can become volatile due to inflation data, political decisions, or unexpected global events. This level of uncertainty means that concentrating your investments in one area can be extremely risky because no single sector or asset is immune to shocks. Diversification works because it spreads risk across different investments that do not move in the same direction at the same time. For example, when stocks decline, bonds may remain stable or even increase in value. When one industry struggles, another may be thriving. By holding a mix of assets, such as stocks, bonds, real estate, commodities, or even international investments, you reduce the impact that any single poor-performing investment can have on your overall portfolio. This balance helps smooth out returns over time and reduces emotional decision-making, which is one of the biggest challenges investors face during periods of volatility. Another important reason diversification matters more than ever today is the rise of global interconnectedness. In the modern financial system, markets across the world are closely linked. A financial event in one country can quickly impact markets on the other side of the world. For example, changes in U.S. interest rates can influence stock markets in Asia and Europe. Oil price fluctuations can affect transportation, manufacturing, and even technology sectors globally. Because everything is connected, relying on one country's economy or one industry's performance is no longer a safe strategy. Diversification across regions and sectors helps protect investors from localized economic downturns or regional crises. Technology has also changed how markets behave, making them faster and more reactive than ever before. News spreads instantly, and algorithms can trigger large-scale buying or selling within seconds. This creates sharp market movements that can be difficult to predict or react to in time. In such an environment, investors who are heavily concentrated in one type of asset are more vulnerable to sudden losses. Diversification helps reduce the shock of these rapid market movements by ensuring that not all parts of your portfolio react the same way at the same time. It is also important to understand that diversification is not just about owning many investments. It is about owning different types of investments that respond differently to economic conditions. Simply buying 10 different tech stocks is not true diversification because they are all influenced by similar factors. True diversification means spreading your investments across different industries, different asset classes, and even different geographical regions. It might include a combination of growth stocks, dividend stocks, government bonds, real estate investment trusts, commodities like gold, and international funds. Each of these reacts differently depending on economic conditions, which helps stabilize overall performance. One of the biggest advantages of diversification is emotional stability. Many investors make costly mistakes not because of bad investments, but because of panic. When people see their portfolio drop sharply, they often sell at the worst possible time. A diversified portfolio tends to experience smaller fluctuations, which helps investors stay calm and stick to their long-term strategy. This emotional discipline can often be more valuable than trying to pick the perfect stock.